I'm happy to welcome you to a session on treasury management and currency management in today's volatile environment by none other than Mr. Haresh Desai, who is an expert on this topic and has got more than 4 decades experience on this subject as to how to handle volatility in foreign exchange. So he is going to share his insights with us today evening. I'll just give a brief about him. He is a chartered accountant and rank holder both in the intermediate as well as final, and passed out as a candidate in the final in the November of 79. And he is a founding partner of Rajwade and Company, a pioneer in the field of rendering advisory services in foreign exchange risk management. The firm is a leading provider of forex risk management services to corporates in the private and the public sector, to Indian and foreign companies. It also renders rate risk advisory services to banks and financial institutions on forex and interest rate risk management. The firm has been involved in preparing treasury management policies for corporate clients in the public domain, like BHEL, GAIL, Indian Oil Corporation, NTPC, ONGC, and the like, and also in the private sector to companies like Bricks India, Larsen and Toubro, Mahindra and Mahindra, Thermax, etc. And the firm has already also done advisory work on treasury-related issues for banks like Bank of India, Dena Bank, Indian Bank, Punjab National Bank, and State Bank of India. He has worked with the firm since its inception in 1981. He has spent 4 decades counseling Indian corporates on foreign exchange risk management. He has seen the emergence of risk management function among Indian corporates from virtually the initial period, nascent period, to its current state of it has evolved, and has advised many corporates and in every phase of its advancement. He understands the Indian corporate risk management process in depth, advising corporates on the management of foreign trade exposures, foreign currency loans, and usage of derivatives has been his core skill. He has conducted over 400 training programs on foreign exchange risk management and also trained a large number of Indian treasury personnel at banks as well as corporates. He has been a visiting faculty at several institutions, including the IIM Indore, Management Development Institute at Gurgaon, and SP Jain Institute of Management in Mumbai. Apart from that, he has co-authored a book under the name Foreign Exchange, International Finance and Risk Management, and published a risk management newsletter called Currency Risk and Management Report. We welcome you, sir, Mr. Haresh Desai, to share your expertise for an evening of learning.
Right. Thank you, Arun, and a good day to everyone of you, given that we are in different time zones. A good day to all of you. Just a little bit of a heads up that I've been a little under the weather for the last few days and might go through a few coughing spells as part of this session. So please, an apology in advance. But let me start with the subject, which obviously is fairly vast, as many of you might know. And I would like to start with a story from Greek mythology, because that illustrates some of the problems that, or some of the approach to risk management that corporates need to keep in mind. And the story goes like this, that like the Indian pantheon of gods and goddesses, Greeks also used to have a large number of gods and goddesses whom they worshipped. There was a rain god and a fire god and god for air, wind, and name it, and there was a god for everything. Like I said, similar to the Indian pantheon of gods and goddesses. But the god of gods was one Lord Zeus. And Lord Zeus, it is said, would always say that Socrates is the wisest of all the Athenians. Finally, one of the Greeks mustered up the courage to approach Lord Zeus and ask him, Lord, you always say that Socrates is the wisest, but why do you say so? And the Lord's answer was that Socrates is the wisest because he's the only one who knows that he knows not. The Socratic line of sort of philosophy was only to ask questions. Socrates never provided any answers. His dialogues with Pluto were a series of questions by Socrates, which would be answered running into a few pages by Plato, sorry, and that would be followed by another question from Socrates. So Socrates never provided any answers. He only asked questions, and Lord Zeus believed that that made him, therefore, the wisest amongst all human beings, because he acknowledged that he did not know anything. And I think that's where treasury risk management should start, which is with the knowledge that the future is unknown. There is no way that anybody can predict the price of anything for tomorrow. And therefore, we should not even attempt to do so. And treasury risk management is not about being able to guess where the markets are going, whether it is currencies, interest rates, or any other. You're looking at stocks, bonds, commodities, any price driven by market forces, always impossible to predict where prices are going. Sorry. And this is mainly because financial markets in general are both extremely efficient and at the same time unpredictable and volatile. Efficient because market efficiency, in fact, is supposed to be in place when no individual can profit from any advanced knowledge. And certainly in the forex markets, which are massive, a multi-trillion-dollar market, all of them having the same information available to them through their Reuters monitor screens or similar information screens. All of them get the same information at the same point in time, large values of individual transactions, and it is impossible for even a cartel to be formed. Certainly in the financial markets. There's also a huge amount of speculative transactions. It is reckoned that over 90% of the trading in the international forex markets has no bearing on any commercial transaction. So clearly, a huge degree of speculative transactions take place. In the forex markets also, very clearly, there is a herd instinct with too many people following so-called trend movements, which often leads to overshooting. Some of you might have heard the sort of age-old saying that the trend is your friend, and many people jump onto that bandwagon saying that the trend is your friend. Unfortunately, the trend is your friend only as long as it does not come to an end, because when it comes to an end, it is no longer your friend, and then where do you go? And very often it is people who believe in such trends who get caught out at the peak when the turn happens, and then obviously are left stranded, so to speak. Because as very important economists of the 20th century, certainly one of the most famous ones, John Maynard Keynes, whose Keynesian theory is something that people still read and practice even today. In a book written almost 100 years back, Keynes has said that in the market, the inevitable never happens. It is the unexpected always. And therefore, one sort of philosophy that we follow, certainly in terms of trying to guess where the markets are going, is that when the entire market believes that something is going to happen, you can be reasonably assured that that is the one thing that will not happen. Because too often we have seen that what the market considers as inevitable never happens. It is the unexpected always. And using this as this starting point, that it is impossible to know where markets are going on any consistent basis, one needs to look at that subject of risk management. And currency risk, or any risk, in fact, is defined as uncertainty of outcome, or more technically, the potential for the price to deviate from an expected value. More realistically, from a treasury manager's perspective, it is the destabilization of the budgeted cash flows or the reported profits from whatever one may have expected to take place. At the simplest level, you have decided to import something and you're expecting an exchange rate of, say, 90 rupees per euro. By the time the import takes place and the money has to be paid out, if the exchange rate becomes 92 rupees per euro, you're going to obviously pay 2 rupees extra. That's the risk. And of course, if the rate becomes 87 rupees per euro, then you're going to pay 3 rupees less, and that becomes the reward side of the equation. And when you're dealing with risk, I think it's very important to appreciate the risk-reward relationship. It is the reality of all markets that risk and reward go hand in hand. If you are a conservative company, and most companies, certainly in India, when asked the question of whether they are conservative, will tell you that they are very, very conservative. If you're conservative and therefore you want to keep your risks low, remember that the potential rewards will also be low, because you'll have to pursue policies which keep your risks down. And when your risks are being kept down, the potential rewards will also be kept down. On the other hand, if you are sort of trading mindset oriented, or willing to take a few speculative bets here and there in the pursuit of higher rewards, or you prefer to take views on where the market is going, and based on that your decisions are being taken, essentially you want to pursue rewards in relation to the foreign currency risk management, then remember that that higher reward can only come with taking larger risks. There is no going away from this low risk-reward relationship. Lower the risk, lower the reward; higher the reward, higher the risk. And unfortunately, there is no such thing as a low risk, high reward strategy in the real world. We all want it. We would like to keep the sort of windows of risk closed, but the doors of the rewards open. But these are all fancy phrases which make no sense in reality. In reality, risk and reward go hand in hand. And obviously, in that scenario, the greater the volatility of an exchange rate, the greater is the risk in relation to that exchange rate. And certainly from an Indian environment, typically the volatility of the exchange rate is the lowest in relation to the rupee dollar exchange rate as compared to, say, rupee euro, rupee pound, or any other currency, because primarily the Indian market trades only in the rupee dollar exchange rate, and therefore the volatility tends to be lower. Whenever a bank is asked to deal in a currency other than the US dollar, it has to undertake two transactions, one for the rupee dollar in the domestic market, the other for the dollar currency in the market abroad. And obviously, you're dealing in two different markets and two different volatilities. Typically, they add up to a much greater volatility in the exchange rates for non-dollar currencies as compared to dollar currencies. As a rule of thumb, therefore, again, for Indian companies, and I would reckon that this is true of most companies in the developing world, the dollar remains the lowest risk in terms of exchange rate movements. And given the option, one should always stick to the dollar as the currency of choice, whether one is dealing in imports or exports. Non-dollar currencies add to the risk, and therefore, to the extent possible, should be avoided. Also, an important element of risk management is the need to look at economic exposures. Economic exposures are exposures that very often are undertaken by the company without having any direct impact or direct exposure to currency risk. For example, take any say metal manufacturing company in India, copper manufacturing, say, for example, their entire domestic sales are governed by the landed cost of imports, because copper is sold by domestic companies to their domestic players at the landed cost of imports. Now, obviously, that landed cost of imports has an element of the rupee dollar exchange rate in terms of the factor. It's the price abroad multiplied by the rupee dollar exchange rate, to which the duties are added, and that becomes the cost of copper in the Indian market. Clearly, for the copper manufacturing company in India, the domestic sales are actually similar to dollar sales, and therefore they have as much risk to the rupee dollars exchange rate in terms of rupee appreciation as a exporter would have. So for example, if the rupee dollar exchange rate, which right now is close to 83 rupees per dollar, tomorrow were to suddenly become 80 rupees per dollar, copper prices in India would all come down. And that represents an identical risk in terms of the cash flows or the reported profits for all copper manufacturing companies. And it's not just copper, aluminum, steel, all of these companies, the entire oil industry, petrochemical industries, a whole host of Indian industries are facing this economic exposure, which often tends to be ignored. And a very important element of risk management, or I would say the first element of risk management, is the need to appreciate risk and to identify your risk. So if you have a large foreign currency loan, but if you also have your entire domestic sales, which are governed by the landed cost of imports, then really your worry should not be rupee depreciation. It should be rupee appreciation, because that is where a greater element of your cash flows are going to be hit. So risk appreciation, identification, extremely important. Where is my risk? And then you measure that risk. So how much is the risk? Risk measurement or risk quantification, again, something that companies are not doing as well as one would expect them to do. In fact, for us, very often a new client means spending 3 to 6 months in making sure that the basic MIS system is throwing up the right numbers, and at a time period which is quick enough, because it's a very often we have seen that a lot of time lapse happens between the time an order is placed by, say, the purchasing department, and it gets registered into the system, and then the finance team is informed about the risk. Sometimes the gap is 15 to 20 days, which is too long in a world where an exchange rate movement of 2%, 3% can happen even overnight. And once, of course, you have quantified the risk, then the question of risk control comes in. And I'll sort of look at that separately when we look at policy in terms of what kind of risk control measures one can have in relation to that risk management role. Important, of course, that we also look at what kind of objectives one can have in relation to risk management. And here I would like you to look at this sort of statement from Alice in Wonderland. It's a book written for children, but I'm convinced that it's actually a book written for adults, because there are any number of situations that Alice gets into which the adult world might relate to much better than children would. And here is one example of that. She reaches a crossroad and she meets a cat which is sitting at the corner of that crossroad, and she asks the cat, "Will you tell me, please, which way I ought to go from here?" And the reply of the cat is, "Well, that depends on where you want to go or where you want to get to." And similarly, unless you are very clear about what the objectives of your risk management policy are going to be, you are not going to frame a policy that will suit your company. And in relation to objectives of risk management, one of the most common objectives that we come across in many companies are that, oh, we want the best rates. Best rates means that I want to buy dollars when dollars are very cheap in the market, and I want to, of course, sell dollars when they are very expensive. Yet best rates are known only after the time period is gone. Only now we can say, for example, even over the last 2-3 months, that at 80 rupees per dollar, which was touched a few weeks back, I should have bought all my dollars, and at 83.25 rupees per dollar, which was touched a few weeks before that, I should have sold all my dollars. But that is an information that is available to me now. And there's nothing much that I can do about it, because I didn't really do anything. In fact, in economics textbooks, it is known as trading in retrospect. Trading in retrospect is look at the past, see where the prices were, based on that decide, oh, at this point if I had purchased and this point I had sold, then this is the kind of money I would have made. Trading in retrospect, it is said, is extremely profitable and completely useless, because it does not add a single rupee to your bottom line. So best rates as an objective might sound very reasonable, but in reality, it is completely useless, because you can know those best rates only after the time period is gone. Budgeted rates may have a somewhat better sort of as an objective, because you are looking forward and you are hoping that you can try and guess where those rates are going to be. But like I warned you right at the outset, remember that the future is unknown. Budgeted rates, particularly when budgeted rates are made for the year as a whole, 2 months before the year has even begun, very often to become nonsensical even before this year has started. Last year, for example, I know that a whole host of companies had budgeted for an exchange rate of something like 76 and 77 rupees per dollar, and ultimately the average rate for the year has come closer to 80 rupees per dollar, and that 76 77 was crossed pretty much in the first quarter of the year itself. So budgeted rates may need either constant revision, or they may need to be only for short-term periods of 3 months at a time. In any case, remember that budgeted rates should be used for budgeting purposes only. They cannot be used as a benchmarking exercise for either taking decisions or for seeing the performance evaluation of a treasury, because like I said, they could easily go awry right at the beginning of the period. One other concept in terms of risk management that you should bear in mind is the concept of insurance. And this is particularly important in relation to option contracts. In the financial world, concept of insurance is very easily understood, that you are likely to face a potential huge loss from a, say, a fire or an earthquake or an accident, and you might end up spending a large sum of money. And in order to protect yourself from that unforeseen unpleasant set of circumstances, you are willing to pay an upfront premium as the insurance premium to protect yourself from a future uncertain, unknowable loss. So the avoidance of surprises is at the heart of that insurance. And the option contract, in terms of the buyer of the option, works exactly like that. You pay an upfront premium and you protect yourself from a sudden adverse movement. So you buy a call option, you have say a dollar liability, you buy a call option on the dollar, say at 84 rupees per dollar, you pay some upfront premium. If the rate happens to be higher than 84, then the bank protects you against that. But if it is lower than 84, then you buy at the spot rate. Now, you must remember that in any insurance contract, for the buyer of the insurance, the ideal insurance contract is the one which is not exercised, the one on which no claim is made. And similarly, the ideal option contract is the one which is not utilized. You don't want to buy an option contract to buy dollars at 84 and then hope that the rate goes to 86 so that you will exercise the contract at 84. You're far better off if the rate goes to 80 and you sort of let the contract lapse without being exercised. And yet, too many companies buy option contracts and then get disappointed when those option contracts are not utilized, failing to recognize the fact that they have actually, those option contracts have worked in their favor because they've protected them from that risk and at the same time allowed them to profit from a favorable movement in the exchange rate. Another common sort of objective that one needs to bear in mind is whether you want to manage exposures on a net basis or a gross basis. Once again, this at the heart of this sort of decision is whether you are conservative or you are willing to take risks. If you are conservative, then you are better off managing exposures on a net basis, because then to the extent you have both imports and exports or receivables and payables, you are netting off the transactions, and therefore you don't need to worry about what happens to the exchange rate to the extent of those net amounts, and look at only the excess in terms of whether you need to buy dollars or sell dollars and take decisions on that basis. If you manage exposures on a gross basis, you may end up selling dollars at a very cheap rate and then having to buy dollars subsequently at a much higher price. So managing exposures on a gross basis is a high risk, high reward kind of strategy. Managing exposures on a net basis is a more low risk, low reward strategy, which is what a conservative company would prefer to do. Lastly, of course, and most importantly, one has to make sure that the objective of the policy is really to minimize risk. It is not to earn money or reduce cost. And mind you, earning money and reducing costs are one and the same thing in terms of what kind of policy parameters you will end up using. Too often companies try to take decisions which will enable them to reduce costs, forgetting that any reduction in cost is ultimately a reward, and that reward can come only by taking some risk. And too many companies, particularly in that period of 2006 to 2008 in India, at least, too many companies have lost their shirts by getting into transactions which they did not fully understand the risks of, in the pursuit of rewards, very often in the pursuit of a lowering of the costs for the company, and ended up losing everything. And of course, a large number of legal cases between banks and their counterparty customers in India. And many of them settled out of court with both sides losing large chunks of money. So it's something that you would want to avoid. And remember that the objective of a risk management policy primarily is to minimize the risk for the organization. You also have two types of derivatives, and there are only two types of derivatives in the real world. One is a forward contract where you lock into a price and both parties are obliged to buy and sell at that contracted price. The other is the option contract, which I explained to you. You buy a right to buy the dollars, or buy the right to sell the dollars. And if the ultimate price on maturity is adverse, then you can exercise the option contract. If on the other hand it is favorable, you can let the option contract lapse and buy or sell at that favorable rate. Remember that an option contract is like an insurance contract, and the ideal option contract, therefore, is the one which is not utilized. In terms of use of derivatives, I think firstly, remember that every derivative is capable of both being used as a hedge as well as by being used for a speculative transaction. So if you have a loan liability and you are expecting the rupee to fall sharply, you can take a forward contract to buy dollars for 31st of March and reduce your risk on that transaction. On the other hand, if you have a view that the rupee is going to fall very sharply, which is the same view that you have taken for the hedge, but you don't have any loan liability, you could still buy those dollars in the market. And if your view turns out to be right, then of course you will make money. But then that is a speculative transaction. And whether a transaction is for reducing risk or for speculative purposes, it's all in the head of the treasury manager. And therefore, auditors require that every derivative transaction has to have a documentary backup which shows whether the intention of that derivative was a hedge or a speculation. And if the intention was a hedge, then the exposure that has been hedged will have to be outlined. The currency, the date of maturity, and the rate at which you are hedging it, all of these details have to be put in place. Any transaction which is not backed by documentation is automatically presumed to be a speculative transaction. And therefore, extremely important that one is whenever one is using derivatives, whether it's a forward contract, an option contract, a swap, or any other kind of transaction, one should have a documentation in place which ensures that you can prove to the auditors that this is a hedge and not speculation. Speculation is especially to be avoided. Too many treasury managers like to believe that they will add value to the business. When I have seen in my experience that most treasury managers who go out trying to add value to the business end up losing value for the business. And too often, since the risk reward relationship is forgotten, it is very often a very high risk, high reward transaction that is undertaken. And when those high risks come home to roost, then of course, all kinds of difficulties are faced, not just by the treasury and finance team, but by the entire organization. In general, as a rule of thumb, no hedging requires any kind of structured product. So whether it is a seagull or any other fancy call spread or excuse me, or any kind of barrier options that are very popular amongst corporates in India, knock in and knock out kind of option contracts. None of these are really required for hedging purposes. Plain vanilla derivatives are perfectly fine. In fact, most of the structured products fail the hedge effectiveness test, and therefore auditors once again for these kind of products will insist that they should be treated as speculative transactions and not sort of qualify for hedges in any case. So difficult to prove to the auditors that any structured product is in fact a hedging transaction. In general, as a rule of thumb, you take a forward contract when you're expecting an adverse movement. You take an option contract when you're expecting a favorable movement. And to that extent, maybe a limited degree of view taking becomes inevitable. When you're taking views, of course, easier to take views on the rupee-dollar exchange rate as compared to the dollar currencies. Non-dollar currencies tend to be volatile. Also, rupee-dollar exchange rate, the RBI exercises a fair degree of control on the market. The RBI's foreign exchange policy is linked to the inflation rate differentials between India and the other countries or the major trading partners. And typically what we have seen over the last 30 years that we have had a market determined exchange rate in the domestic interbank market, we have seen that the Reserve Bank of India's intervention points typically get determined by the inflation rate differential between India and the major trading partners. Given that India's inflation rate has been higher by about 2 to 3% per annum, the Reserve Bank of India also has tried to ensure that the rupee falls against the currencies on a secular trade-weighted basis to the extent of about 2 to 3% per annum. In fact, if you take that entire 30-year period, yes, the rupee has moved from 31 rupees 37 paisa per dollar in March 1993 to now 82 rupees and 75 paisa per dollar. But this entire move can be explained by inflation being higher in India than inflation in the markets abroad, and therefore the desire of the central bank to keep depreciating the rupee to ensure that exporters do not suffer in the markets abroad and their higher costs of production are compensated through the exchange rate. Similarly, to ensure that the importers do not face unfair competition from the markets abroad. So it is both a protection to importers from competition from abroad as well as to the exporters from adding to their competitive value in the markets abroad. And since the rupee is given to sort of be seen to be falling by 2 to 3% per annum, in general, as a rule of thumb, we have seen that a consistent policy of selling dollars forward has worked very well for Indian exporters. Which brings me to the hedging policy that one needs to keep. Any open position, remember, is a speculative position, whether one keeps the imports open or one keeps the exports open. Like I mentioned, in general, rupee depreciation has been lesser than the forward premium, and therefore actually exporters who have kept open positions have taken bigger risks than importers who have kept those positions open. And whether you are talking about payables or receivables, there has to be a management imposed limit on the net open position, which represents the risk that the organization is taking in relation to currency movements, and there has to be a limit on that net open position. Similarly, whatever are those exposures that are kept open should be benchmarked, and whatever is that benchmark that is used, there should be a stop loss relative to the benchmark. How much money, after all, are you willing to lose in relation to that open position should become the guiding principle of risk management. Not how much money you are going to make, but how much is the maximum money that you're prepared to lose in relation to risk management should be your guiding principle for a forex policy. I have many companies that turn around and tell me, but we are not wanting to lose any money. If you're not willing to lose any money, then your net open position should be zero at all times. You should make sure that you're fully hedged at all times, because if you're not willing to lose money, then you cannot afford to keep any position open in the hope that you will make money out of those transactions. In the absence of these kind of rigorous and well-defined systems, too many times for the treasury, an out of the money position becomes a hedge. So if I have taken a forward contract and the rate worsens in relative to that forward contract, I have bought dollars at 84 and I find that the rupee dollar has moved to 80 rupees, I have potentially losing 4 rupees, that becomes a hedge against a payable. On the other hand, if I've bought dollars at 84 and the rate has become 86, I will show that is a trading position, make money, and show how the treasury is doing extremely well at all points in time. So very important to have a well-defined system, and especially if the treasury is to be regarded as a profit center, then benchmark rates are critical, because without that, it will be impossible to undertake any kind of transfer pricing mechanism. Even performance evaluation will be a impossible exercise. Sorry. And then finally, of course, an internal audit system, training of those internal auditors to ensure that they understand how the system is supposed to work is a key element of any hedging policy. Sorry, that's what I wanted to cover in terms of preliminary remarks, and I'll be happy to take any questions.
Thank you, sir, for an excellent presentation. I believe that you have to stand in the place of Zeus, and we are all in the shoes of the questioner to learn more about this. We laid out the framework for risk management and treasury operations very clearly. Thank you for that. I have a question in the chat box from Sharon. In the current global environment with geopolitical risk, potential increase in trade wars, deglobalization reset, does currency fundamental PPP, purchasing power parity, over the future long term still hold?
Insofar as the major currencies are concerned, whether you look at dollar euro, dollar yen, dollar pound, or any of these major currencies abroad, those economic fundamentals have not worked even in the past. Even if you look at the last 40, 50 years, after all, we have a sort of market determined exchange rate in the international markets right from the breakdown of the Bretton Woods system in 1971. We have seen that economic fundamentals rarely play a big role. That is partly because you name an economic fundamental and I can give you opposite arguments of whether that will result in dollar appreciation or depreciation. And by and large, people who have used economic fundamentals in order to determine where rates are going have failed. And I don't see that changing in the near future, even if geopolitical tensions die down. But you're absolutely right. In the face of the kind of geopolitical tensions that we are seeing right now, in the face of also the kind of trade barriers that are coming up all over the world, both on the Western countries side as well as on the developing countries side, it's going to become that much more difficult for economic fundamentals to play any kind of role in relation to the exchange rates. However, when it comes to the rupee dollar exchange rate, because the Reserve Bank of India remains a big daddy in the market, willing and able to influence the rupee dollar exchange rate, I would feel a lot more confident that the basic economic fundamental, which is the inflation differentials between the rupee and the major trading partners, will remain in place. But that has more to do with the dictates of RBI's forex policy and nothing to do with what the market is able to achieve. In fact, in relation to that RBI policy, in my training programs, I always use the example of a poster that I used to see during my college days. And the poster had a cat sitting on a throne. And the poster read that you are entitled to your opinion as long as you agree with mine. And Reserve Bank of India's forex policy is like that. That the market can decide the exchange rate, provided we agree to what the market is doing. Otherwise, they will come in and buy dollars, sell dollars. They will change interest rates. They've been known to change even exchange control regulations in order to achieve their objectives. So, and their objective has clearly been to ensure that the rupee does not fall by more than the inflation differentials, and at the same time does fall to the extent of at least the inflation differential. So rupee dollar economic fundamentals, yes. Non-dollar currencies economic fundamentals, no.
Sir, I have another question from Vineet Jain.
Yes.
Sir, you have mentioned in slide 8 that forwards, when adverse movement is expected, and
Yes.
options otherwise.
Yes.
But if I relate it to capital markets, isn't it a put option bought when isn't a put option bought when markets are expected to go down? That is adverse.
Sure. Now, the difference being that in the stock markets, when you buy a put option, you're buying it essentially as a trader to take advantage of a falling market. You are not buying it to protect your existing shares, which you are hoping to sell. While when you are dealing in the foreign currency market as an importer or an exporter, you are buying the put and call options essentially to protect your exposure. So the outlook of the hedger is completely different from the outlook of a trader.
Obviously.
And therefore, you're right that in the stock markets, you will buy a put option when you're expecting the stock prices to fall, but not so in relation to, it's the exact opposite.
Absolutely. Got it. Thank you.
Sir, I have a question. In the last slide, you had mentioned about the benchmark rate that is going to be used for determining the profitability of the treasury management.
Yes.
The profit center. So how do you get to that benchmark rate? Or is it the lending or the cost of money is made available from the corporate finance through the treasury center that is treated as a benchmark?
Depending on what you are looking at. So yes, if you're looking at, say, if you're taking a foreign currency loan instead of a rupee loan, then obviously it would be the cost of rupee finance, because you want to ensure that your foreign currency finance is not going to be worse than your rupee finance, at least keep the benchmark as that. But if it's an ordinary trading related import or export, then logically it would be the forward rate ruling on the day on which the exposure is taken. So let's say the exposure is taken today for a payment that is to go out in June, and that payment today can be hedged at say 84 rupees per dollar. Then logically 84 becomes the benchmark rate because you have given up that rate. If you're not buying dollars at 84, the only logical reason why you're not buying those dollars at 84 is because you hope to do better. Did you do better? Therefore, the forward rate is what we favor as the benchmark. But different companies do adopt different methodologies for arriving at that benchmark rate. Sometimes they use their own budgeted rates as their benchmark rates. Not something that I recommend, but different people do that. More important is there should be a benchmark rate so that both sides are clear as to what is that performance evaluation that is going to happen against.
RBI frequently refers to a rate called real effective exchange rate in terms of setting the currency dollar exchange or rather the likely what they would like to have. Is it, can you?
This is exactly what I mentioned about the RBI policy, that it is inflation adjusted. So real meaning adjusted for inflation, effective meaning trade weighted, and ER is the exchange rate. So the RER, or the REER as some people call it, the RER is nothing but the real effective exchange rate, which is the inflation adjusted trade weighted exchange rate. And yes, that is what they are using. And given that the sort of rupees depreciation, you can track almost. The only thing is that RBI's intervention points are obviously not on a daily or even a weekly basis. So there are sometimes overshooting and undershooting that happens from time to time, or overvaluation and undervaluation from time to time. For example, right now, we believe that there is an undervaluation by about 3%. So that RER index is at 97, which indicates that the rupee really needs to go, or rather the dollar needs to fall by roughly about 3% from where we are.
I have a question from Anup Agarwal.
Sure.
On your point about all exposure can be hedged with simple contracts, no exotic contracts are required. He says he is facing a difficulty often. A company in India has US dollar denominated floating rate loan. Interest cost is in INR, cannot be hedged 100%, right? The SOFR movement will change the USD exposure in this question.
So in the interest rate market, that forward contract is called the forward rate agreement. And a forward rate agreement is very much available. Also, they have what are known as interest rate swaps. And interest rate swaps are also available. And these are nothing but forward contracts. So they are called interest rate swaps, but for all practical purposes, they function like a forward contract. And so, yes, I would recommend that you look at forward rate agreements or interest rate swaps for moving from SOFR to fixed rate, provided you want that. I don't know whether timing wise, this is a good time to move from floating to fixed, given that I think there's very limited room now left for interest rates to go up even in the US. And that is more likely to be followed, at least over in the next year or so, by a lowering of the interest rate cycle. So timing wise, it's not something that I would recommend, but timing is something that you can never get absolutely right. So bear that in mind. And if you're looking to hedge out your floating rate risk to a fixed rate, it is available. You have to ask for the bank for either a floating FRA, which is the common for a limited period, sort of locking into an interest cost forward rate agreement, or you can look at an interest rate swap over a longer period of time.
Ladies and gentlemen, please remember that the expertise of Mr. Haresh Desai is available for professional consultation at the coordinates that has already been shared with you. I've had a personal experience with his advisory and I had found it useful. So if any of you have any such issues to be addressed, I would urge you to approach him at the coordinates what he has shared. Sir, one last general question is in current scenario where we are presently are, India, will it help if we pitch for full convertibility, which is kind of already there? What is your take on that, sir?
So no, my view is that full convertibility is something that is neither required nor desirable. After all, as far as the foreign investor or lender is concerned, the rupee is fully convertible in any case. Convertibility simply means that you can convert your rupee assets into dollars or vice versa. And that is fully available for foreign investors in any case. For Indians also, for most of us, up to $250,000 a year, it is fully convertible. We can, how many of us really have $250,000 to convert it? It is for all practical purposes fully convertible. To do it fully convertible on capital account for everybody to any extent is perhaps not desirable, because right now political environment is very good. But tomorrow, if the political environment becomes shaky and people start losing confidence in the domestic government, then that can become an extremely dangerous situation. And it's not something that you can walk into and walk out of all the time. So no, I don't think it's required.
Thank you, sir. I urge all participants to share their experience of the session in the chat box for a recording and review for our, it's a kind of a feedback we look forward to from all of you. I request each of you to share your feedback before we close the session. Thank you, Mr. Desai, for an excellent presentation. And especially in the current environment, we have got clarity as to what we should do. And then we should go where the road to be taken is where we really want to go. I hope my colleagues have gained from this evening. So thank you, sir. I'll just,
Thank you so much. And once again, an apology for the bouts of coughing that.
Absolutely not, sir. Thank you for coming. And in fact, you are not in the best of health. Even then, you maintained that you would want to take this session. So we are really obliged by that. Just one last question. Your esteemed organization, does it take care of the clients in the US and outside India as well, related to all these aspects which we talked about today?
We do advise, yes, but our focus essentially remains India centric. So yes,
Right.
advice,
So the
yes.
foreign companies having their offices in
And
India and presence in India, those can be
typically,
taken.
yes. Those are the ones who typically would reach out to us. Yes.
All right. Thank you so much.